use what's called the 5 C's of credit. So if you are ever trained in commercial lending, you're going to learn everything there is about the 5 C's of lending. Some of them we are already working on and you didn't even know it. The first is character. That when you're going to make a loan, you want to look at the individual that's running the company, What is the person? What is their history of success? What is their reputation in the community? Do they have good character? So if you have somebody that has been in business for 20, 30 years, has a reputation for being involved in the community, being a good corporate citizen, but also of repaying their debt, their ventures are good, they have good character. So that's the first thing a lender is going to look at, is the character. In the Rochester area, we have people who have opened up one restaurant and they run it for a year and then they don't pay the sales tax, they don't pay the bills, and they drive the corporate entity into bankruptcy. They open another one and they do the same thing. Other people have situations where they don't treat their employees right. They're always trying to cheat the customer. Those things are character. And if you're going to lend money, you want to understand the character of the individual. The next C, second C, is credit. And how have they handled obligations in the past? Now, what we're going to look at now, we're going to base it on personal credit, but commercial credit is the same way, the same situation. All credit activity is reported to a credit reporting agency, which tracks individual history. That can include TransUnion, Equifax, Experian. So you have somebody who tracks all of the credit in the U.S. individually and corporately. So if you borrow money from anybody, and that includes your cell phone, that may include certain apartment rentals, health insurance, any number of things that involves anything close to credit, that information is tracked and reported by a credit reporting agency. So that's the reporting agency. Now, over time, there's been behavioral and statistical models that have been developed that are predictive of future ability to pay back loans. These are mathematical, behavioral, and statistical models that have been predictive future ability to repay loans. These models are used by most lenders, and that determines who gets credit, who gets insurance, and what price they will pay for it. The most commonly used score is one computed by Fair Isaac, also called FICO. And the scores range from 300 to 850. They're mathematical scores, 300 being the worst, 850 being the highest. And you can go to this right now and you can look at the site. And I encourage you to go look at the site, play with it. I encourage you, if you have not run your own credit report, do so now. We're also going to take a look at this video which explains what FICO is. Let's look at that for a moment.
My FICO score? Not a clue.
My what?
My who?
FICO score?
FICO?
What's FICO?
I have no idea.
No, I don't know my FICO score. Do you, Ava, know your FICO score?
What's a FICO score?
I'm good with numbers. I know my ABC. I even did quite well on my SATs. But there's one score I've never really understood. Don't understand my credit score, and that ain't no good. I got the old low, solo, FICO credit score blue.
Credit scores range from 300 to 850.
Wanted a condo, I needed a loan. I called the mortgage broker on the phone. He crunched some numbers, came back with some real bad news. My FICO score was so low it even gave him the blues. I got the oh no so low FICO credit score blues.
A library fine that was past due ruined my credit. This meant that I couldn't purchase a home, and I had no idea.
Got the oh no so low FICO credit score blues.
I got the oh no, so low, FICO, credit score.
Bob has no credit cards, he pays with cash. So why is his FICO score still falling fast? He found the answer on his credit DVD. He didn't have himself a credit history. He's got the oh no, so low FICO credit score blues.
Now this is how bad it really gets.
Sue missed the payment.
Once or twice.
It wrecked your score.
They raised her rate.
She paid the price. Do you think when we're standing at the pearly gates,
St. Peter's gonna ask about our interest rates?
I got the oh no, so low FICO credit score blues.
Now I gotta do gold.
it's lofty and nifty?
Someday I wanna have a FICO score close to 850. I'll work real hard, I'll play the game, I'll learn all the rules.
How come they never taught me this stuff in school? I got the oh no so low FICO credit score blues. I got the oh no so low FICO credit score blues.
I got the blues.
I can't believe my credit score was that low. I mean, how did I have this happen? How can it be?
Better
Well,
find out.
how can I fix this? And I want to do it right now.
The FICO credit score blues.
I think that gives you a little sense of what it is and how it's used. Many things go into this score, this mathematical score, your FICO. And it includes payment history, which is the biggest piece of the pie. Now, these are estimates that people have made. Fair Isaacs hasn't disclosed that, but this is what it's in thought to be. Payment history. We're going to go through each one of these. Is the biggest, followed by amounts owed, followed by the length of credit history, followed by new credit, and then the types of credit. So it's a combination of a number of different things. The first one and the largest is payment history. And what that essentially does, it goes through every account that you have credit with, and it indicates, have you made your payments on time? And if you have, then that's clean. No negatives there. It measures, though, when you're 30 days late, 60 days late, or 90 days late. So if you get your bill on, say, the first of the month, and they give you to the 20th to pay it, it's not going to be late until it's 30 days past the due date. Okay? So that would be measured by times late 30, you're 60, 90. So you'll see it reported in the credit reports, and the FICO score measures how many times you've been late: 30 days, 60 days, 90 days. And they look at that to get a sense of how you are paying. And these statistical and behavioral models would say that if you have a habit of paying late consistently, and that's when you look in. If it's one, you're all right. But if you got this happening constantly, that's an indicator to the lender that you don't always pay your bills on time. That indicates greater risk. And they look at it relative to the numbers of accounts. If you have 50 accounts and you were once late 30 days, that's going to have an impact, but it's not as bad as having 10 accounts, all of them with 10. One can be rationalized as a mistake or an error, but the higher the number, the worse it is. Okay, and it moves up very quickly. because that's the key part of that model. Adverse public record, that means you have collections. Okay, that somebody has filed a lien, a judgment, is trying to recover money for you. It's in collections. Those are reported that way. They also look at times past due. So when you look at all of these things, this is about 35% of what goes in. Now, this is true. This is from a personal perspective, but businesses have the same thing. So this is the biggest thing. So times late, how big is it relative to that? And the time since past due. Amounts owed. This sort of makes sense. How much do you owe on your accounts all over? Okay, how much do you owe? The bigger the amount, the greater the risk. Now, income does not go into the credit score. Okay, that's what a lender will gather when we look at what is the ability of the borrower to repay. That this is the amount owed on accounts. They look at it by type of account. They look at a mortgage account differently than a credit card, which is looked at differently than a student loan, which is looked at differently than a car loan. They're each looked at individually. If you're looking at a mortgage loan or a student loan, those are paid back over a long period of time. And you look at credit cards, which have a shorter period of time along with cards. So they look at it by specific account. And sometimes if you actually have a lack of a balance, that can hurt you too. So if all you have is a mortgage, you don't have any credit cards, you don't have anything else, that can be negative. They also look at number of accounts with balances. So if you have 10 credit cards and they're all in use, that's not always as good as 10 credit cards with some smaller balance or no balance. Now, the next one is really a freebie, and what they look at is the proportion of credit lines used, meaning they look at how much do you have outstanding versus the amount that they've given you, what's your credit limit. So if you have $1,000 outstanding and you have a $2,000 credit limit, you are 50% used. If you have that same $1,000 and you have a $5,000 credit limit, that's only 20% used. Once you go over 50%, that's bad. The higher that percentage, that is going to negatively impact your score. So now you say, well, okay, that makes sense. If you're all the way up to the top, that means you may be spending more than you can repay or more than you're earning. And it's telling a lender that perhaps you don't have any more room to wiggle. Now, what I encourage many people to do, and I would encourage it with you as a younger person, to make sure you do have a credit card. I make sure your credit card is tied to your checking account so there's no overdraft fees, because overdraft fees are very costly and embarrassing because your check or other transaction could be returned. So what you want to do is, if you have a $500 limit and you've had the account for a while, go ask for more. And you want to keep doing that until you get up to a comfortable amount. I'd say you should have at least $5,000. That doesn't mean you need to use it. It's just going to keep that proportion very low. If you keep if your limit is only $500 and you charge gas twice a month, you're going to have that balance. Even though you may pay it off, it's at a point in time. So you want to make sure you keep this proportion as low as possible. The other thing they'll look at is the proportion of installment loans, which generally car loans, boat loans. Think about this from a risk. If I've just got a car loan and there's 60 months of payments to be made, that's a lot more risk to someone than if there are 3 payments left. There's less risk. So the model looks at all these things and puts them together. length of credit history. How long have you had credit? How long have these accounts been opened up? They look at them by specific type of account. They look at them the time since the last activity. So since I'm old, my credit report goes back many years. Okay? Yours is relatively new. So the longer the history and your history of paying on time, that becomes more predictive of how I will handle my debts going forward. Since you may not have had credit established, there's not a track record. So that could reduce your credit score. The other thing they look at is new credit. Number of recently opened accounts, the proportion of accounts that were recently opened, what type of accounts, how many credit inquiries have been made on your account. Now, if you're looking for a car, you may get 5 inquiries, but they put them together because they know you're looking for one. Time since recent openings by type of account. So look at new credit. Next one is really one that a lot of people don't think of is, do you have credit? Do you have a variety of credit? Credit cards, store credit cards, installment loans, mortgage, consumer finance. They are looking for individuals to have a variety because that'll give us how you behave in different ones. So that's credit, okay? So that is a very important thing. You have a record. Businesses have a record. How have you behaved? Are payments made on time? Okay? Because that is going to help you determine that if I am going to extend credit to you, do I want to based on your behavior? If you have a low credit score that's giving me more risk, I may not even want to lend to you. Okay? And if I do, I'm going to charge more. The third C. This one, we've been spending the first 3 weeks of class talking about this. Cash flow. You repay debt by cash flow. As a lender, you're looking at cash flow. And that's the capacity to be able to repay the debt. You got to see what's out there. So everything we've been talking about is this third C of credit, the cash flow. Lenders need to understand the cash flow. But if I'm trying to sell a banker, if I'm the CFO, the treasurer, and I'm trying to sell a banker, I have to provide all of this information so I can convince them to lend me money. So that looks at sources and types of income, and there's different guidelines. And the guidelines vary. For an individual perspective, we always look at it that housing costs should be 30% of income or less. Total debt should not exceed 35 to 40%. We have guidelines on the commercial side. So the third C is cash flow. You already are getting the importance of that, how you can evaluate the company, and that's how it fits into credit and that. When we look at cash flow from a commercial guidelines, it depends on the type of loan, which comes back to your cash conversion cycle. Okay? Is it a working capital loan? Is it a loan that we need for seasonality? Is it a line of credit to get us through that period of conversion? Operating cash flow, debt in the range of 125 to 175. So that's the cash flow. The fourth C of credit is collateral. If you can't make the payments from your cash flow, how will the lender get repaid? Now, as a lender, I want to be repaid. I don't want to take something back. So I'm always looking for a second way out. As a lender, my goal is really to get paid back from the cash flow of the company. But I need to have another out. In fact, I like to have 3 outs as a lender. So the first one is collateral. What property or equipment can be pledged to make the loan better than in case? So the greater the collateral, the better. So if you want a mortgage of $50,000 and the building is worth $10,000, you won't get a mortgage. But if you want a mortgage of $50,000 and the building is worth $150,000, that's good because you have a lot of collateral. So if you didn't pay on that $50,000 loan, we could sell the property and have enough back. And the type of collateral often drives the price because there's time and money to convert. If you pledge your car, I have to go pick up that car, sell it, and that makes that collateral more risky. If I am sitting on a savings account balance, it's much easier. So we look at the type of collateral and then the value of collateral, which we talked about. What is it worth? So collateral is the fourth C. So if I'm making a loan, I want to make sure the character is good, the credit is good, the cash flow is good. Make sure I have a second or a third way out. On the collateral, it can be a physical asset, it could be a business, it can also be the guarantor of someone else. So if I'm running my own business, which I do, I have to guarantee the debts of the company. So not only does I have a real estate business, not only does the bank look for my cash flow from operations to repay the debt, they look at the value of the property they have the mortgage on, and in the event I can't pay it from what I'm getting from my rental income, and they sell it and they can't get it back, they have my personal guarantee and my personal assets at risk to do that. So they're very well secured. You probably would find that credit problems happen when you don't follow these 5 steps. The fifth C is common sense. Does the transaction make sense? Is the story believable? Okay? And this is a real tough one because sometimes a deal just isn't right. Okay? It's not practical. There's not enough experience of the individual running it. The location may not be the best location. If somebody said, I want to build a 20-story office building in Geneseo, New York, you'd say, no. There's not it doesn't make sense. Okay? There's no logic behind it because Geneseo, New York does not need this huge office type. Is the story believable? Yeah, the price is reasonable for what they want to change. Is their business plan reasonable and have common sense? So if they're going to open up a yarn store, okay, and they're going to hope to get 5,000 customers a year, and you're based in Geneseo, New York, guess what? There's not 5,000 people who are going to buy yarn from you in Geneseo. That's what common sense is. So those are the 5 C's of credit. Number 1, character. Number 2, credit. Number 3, cash flow. Number 4, collateral. And number 5,